So thanks everybody for showing up. This is a new format we're trying out, and I hope it's going to be successful. I think it will be. Most of our sessions are in the evening. If you didn't hear me say this a few minutes ago, we usually get a little bit more in depth. We have a little bit more time, but we're trying out something new, maybe a different group of people that are available during the day who have some trouble at night. I have small kids at home. That makes evening sessions really hard on me. So maybe we can meet some new people here. Our format is 30 minutes during the lunch hour. We'll invite one speaker, we'll focus on one subject, and we'll have just a couple of questions. So it's a little bit quicker. And if you like this, you should check out our evening sessions for sure. Take a look at our social media sites or fi.co. I'll post all that stuff in the chat. These sessions are always free, and it's a great way to meet other people someday after coronavirus when we do this in person. And also just learn a lot about startups and small business. My name's Quentin. I'm one of the city directors in Frankfurt. Aoife's here and is going to help me today. She's a city director in Cologne. Aoife, maybe you can introduce Nathan and tell us about your new session, because you just started yesterday, I think, right?
Yeah. Hi, everyone. I'm based in Bonn, but I'm leading the Fund Institute chapter in Cologne. And yes, we just started our cohort for 2021 this week. And it's been very exciting. We have a small group of entrepreneurs who are very eager to do something impactful. We have Nathan here today, and Nathan is actually a CEO of a fintech company. And Nathan, correct me if I'm wrong, you just published a book on e-commerce, right? Can you tell us more?
No, that book came out a while ago,
okay.
and that was simply a little handbook that we probably wrote when we knew far too little ourselves, but I think it was quite to the point. Coming up later this year, there's actually a handbook on financing innovation that's coming out on Springer, which is a far more serious work. And I'll be writing a couple of chapters in that on alternative lending and subsidies as well.
Cool. And what about your company, Fulfin? I know that you know quite a lot of about startup funding and maybe not even so popular methods of getting finances for your startup. Can you tell us more about that?
Okay, so I have a couple of slides at the end. I'll push the company in the self-promotion probably down to the bottom, but I can say a couple of sentences is that we are a specialist lender. We provide liquidity management services, or alternatively expressed, cash management services, purely for online businesses. That's our focus, and our core product is working capital loans, and these loans are collateralized. So it is one way of skinning a cat, and the cat that we're looking to skin is how to effectively finance a young company as they transition from startup to scale up.
Got it. You're also director of the Fund Institute in Munich. When you're actually also starting your own cohort in a couple of weeks, right?
Mm-hmm. Yeah, we hope to start with something like 30 founders.
Cool.
Which will mean less sleep for me again, but more interesting conversations and office hours, as you know. Something I'm very passionate about, and due to my inability to say no when people make me exciting offers, I started being a director in 2018, about the same time that I founded Fulfin as well. Not something I would recommend for most people, but it works for me because it's highly correlated. I get to see these young cases. I get to see how they struggle with financing, and that kind of fertilizes my ideas for Fulfin as well.
Yeah, I mean, financing is a topic that all startups care about. Probably that's even the first reason they start looking into joining accelerators. Quentin, shall we move into the presentation, or what do you say?
Yes, please. So let's get going. But if anybody has a question, put it in the chat. We'll collect those and ask questions at the end. So go ahead, Nathan.
I will be showing my desktop, and then we'll go from there, I think. And I will just pull back. So do you guys see the presentation?
Yep.
Perfect. Okay, so I just need to move you down. Okay, so we have something like 25 minutes left, and I think this time is most productively used if we give you a top-down view of all of the alternatives that you have and those that you do not have when you're building your company at the different life cycle phases. So I think in startups and companies generally, it's so usual to think about your tech stack, and it's so usual to think about your marketing mix. or even your marketing stack, as we refer to it these days. But I would like to hear a lot more consideration given for your financing stack. Basically, the understanding that money is an abstract concept, but you can acquire and keep and return it in many different ways. And how you do is going to have an effect on how your company develops and the level of ownership that you actually end up having of your company in the end game. So that's what I hope to give you some insight for today, and to open your eyes to a financial product or a group of products that are termed alternative lending or alternative finance, and to let you know what they are and how you might be able to avail yourself of this type of financing as you transition with your company from idea to incorporation and beyond. So I will just move forward, introduce myself already. So this I'll keep very brief. I also have startup investments myself, so I've seen investing from every side, from the company, from short-term working capital loans that we provide. We ourselves at Fulfin, we eat our own soup. We are financed ourselves by a mixture of equity and debt capital, which is perfectly efficient for us, and also via our own funds, and from a VC company and an angel company. So we really have different forms of capital from different players at different times in our maturity, which has been one of the keys to our success, and also us being able to retain control and ownership of our company at this point. My background, that's not up on this slide, is simply that I studied physics. I've never worked as a physicist, but I say you can take the boy out of physics, but you can't take physics out of the boy. And I love problem solving. And this is one of the, I think in the domain within which we work within startups, how to finance your startup. Financing is simply the constraint. Everything else you can learn, everything else you can work at, and finance you need to solve externally. So we'll run through this agenda today. As I said, it's going to be top down, and we'll start with, I think, probably the most interesting slide. It's a little bit busy, but I just want to give you an overview of all of the different types of capital, and probably you'll look at it and go, wow, I didn't actually realize that there were so many different ways of borrowing money or taking investment. And then we'll continue and zoom in down from there. I want to just point out at a very high level of segmentation, a dichotomy between equity and debt financing, and you understand the key pros and cons to each type of financing. The question is, what is better, equity or debt? And the answer will be, it depends. And that's what I hope to give you some insight, so you know under which circumstances which is better or worse. And then we're going to run through alternative finance, a quick definition of what it is. And I'm just going to give some insight into 3 products. This is not an exhaustive list, but these are the 3 products that are most relevant in Germany today. So let's move into types of capital. So we spend a little moment on this slide. You'll see we have like an x-axis, which is effectively the timeline of a typical company development. And then we have different types of financial lending products or of credit that you can avail yourself of at different points. So they're each placed in a box where they first become relevant for you. You can have these types of financing continuing. So when you have your own funds in your company, right at incorporation, when you go and you pay in your paid-in capital, obviously that money will generally stay in until you exit. So that's will always be a source of liquidity for you. But as you mature, you will need more money beyond your own means, and then you'll be able to turn to different providers with different types of products. And we're going to split these broadly into debt and equity products. There are some hybrid products that sit between, but at the end of the day, they will all transition into one form or the other. As you can see, pretty much at every life cycle stage, you do have access to all products. Even though we have in seed, here we only show the equity product. In seed, you can still use your credit cards, and you might have access to early factoring providers as well, and you can use product financing a little bit. So this is a kind of a general orientation. Well, the truth is, you'll probably see as we go from left to right, the orange becomes a little bit more prevalent, and that is because providers, financial service providers, are more willing and able to lend rather than invest in companies that are mature and have solid cash flow, so that they can understand that how their funds are going to be paid back within a certain time period. And that's what debt basically is. Debt is an investment which you are going to pay back within a given defined maturity, and equity is effectively an investment that you're taking into the company that doesn't have that constraint. So let's move on and have a look at the pros and cons. So let's look at equity first. Equity is wonderful in many ways because you take in this capital, and firstly, you don't have to pay it back. You don't have, there will be a return to that investor, but it will not, there's no date that says on the 27th of March 2023, you will be paying 17,254 euros. And that's an immediate way of alleviating any pressure, any financial pressure, and also, let's say, on the company, and mental pressure on the founders. Equity, because of how the characters of that type of capital, you will have access to larger investments as well. People will be buying a portion of your firm. So typically, every time you take an equity investment, you'll dilute something like 15 to 25% of your company's valuation. And we know valuations at seed stage, pre-seed, we're talking 500,000 and up to 4 million onwards as we go larger. So you can really take in a lot of capital to build the business. Often it comes with support as well, and these can be services from that equity provider because they're very much aligned with you. They have a long-term alignment with you. They want your company to achieve a valuation. That is how they get their return to capital. They don't charge an interest rate. They work on a multiple. They put money in, and when the company is sold, that the money will come out at a multiple of what they paid in. And by taking in equity as well, you create a solid balance sheet for your company, and that gives you a good basis to then be able to go and get debt financing on top. So there's a lot of positives about equity, but there are certainly some very, very serious, let's say, contras to be considered. And this is the second that you let somebody else into your company and take an equity investment, you have another stakeholder. And that other stakeholder means that your control diminishes, and your control and your ownership can diminish over proportional to the investment that you take. That brings us to our second point, and that is the contractual complexity. If I were now to, we're in the presentation, so I can't do this, but if I were to hold up our full fin lending contract here, you would now see it's basically a three pager with an annex. Enabling companies to go and access up to 250K. If I were to show you the contract that we ourselves at Warenfinanzierung have for the equity investments that we took, then this is a contract that runs over 150 pages. And I would probably be lying if I said that I understood everything in all of its intricacies of what I've actually signed there, but that's why we needed good legal support to close that equity investment ourselves. When you take an equity investment, you're married to that investor. I write here no clear exit strategy, and by that I mean that if you take a loan, there will be a date when you pay back that loan, and at that point that provider of credit has no further claim on your company at all. You're out of the relationship, and you're free to take another loan if you want to finance out of cash flow to go and get an equity investment, but you have no further commitment. Raising equity is extremely expensive. As referred to before, you often need, due to the contractual complexity, you need to go and be involved with specialist lawyers who are starting at 300 euros an hour to get out of bed. It takes a lot of time as well, and that is time where you as a founder can spend working on your business. So you need to kind of be aware of these things, and you certainly need to be aware of your own liability in these contracts as well, and be very clear that you take great advice. So let's move on to debt. The most significant advantage that I can think of in debt is the speed in which you can access funds. So I term it here time to funding. So typically we would say that for an equity investment in a startup, it will require a founder to work on that for 20 hours a week, somewhere between 3 and 9 months to secure a funding. At Warenfinanzierung, as a alternative lender, which is the same with other alternative lenders, we will reach a decision within 1 day, and we will pay out funds within 2 days. Even banks, which are a very tardy form of debt capital, they're very slow in their decision making, they're very slow in paying out. Even the slowest loans from a bank like KfW, you will be able to get through that process in 3 months. So it's much quicker way of funding your business. When you take in debt, you have a liability that sits on the balance sheet, but you do not have you do not have somebody in the capital structure. So you maintain full ownership and control, and you're free and flexible to pay back that capital pretty much at any time you wish, which is a great advantage, and then to clean up your balance sheet. So what are the disadvantages? Generally, the limits are lower than they would be with an equity style investment. Very often is the case that in the early stage, because your company itself has no intrinsic value and its cash flow is questionable, that you will be asked to sign some form of guarantee, which will be personal liability. I think this is perfectly acceptable when you're founded at a very early stage and you're signing for 4 figures and maybe 5-figure sums. And it's totally understandable that as your company starts to scale and you need hundreds of thousands rather than tens of thousands or thousands, that it starts to feel a little bit disorientating and you get dizzy. And it's not really what we want to be doing, to be basically committing our lives and our life savings to something as fragile as a startup. You do have to make repayments on debt. Generally, they're often periodic. They're often, but not always, ex ante defined. So you'll know the dates of them, and that means at that point you really have to make sure that you're in the position to repay that. Otherwise, you do risk insolvency within your company. And this insolvency risk can be compounded by something that is called covenants. And covenants is something you should be aware of as soon as you take any kind of debt. And these are terms and conditions within a lending contract which allow the lender to accelerate repayment. So if something happens within your company, if you do not hold enough equity, if it could be that your sales go below a certain level, there are terms and conditions that can be written into lending contracts which make the principal immediately repayable, and that can cause a great danger to your company. So that's something to be acutely aware of. So let's move on to alternative lending, which is then a subcategory of debt and is distinguished then from other types of lending. So let's just quickly define alternative finance and alternative lending. So alternative finance, in a broader sense, is channels, processes, products and instruments that are in the financial domain, but are not within the banking domain, in where we are talking about regulated organizations or within capital markets. So hence alternative banks and capital markets have been around for decades and even centuries beyond that. And it's a highly regulated, well-structured environment. And in the last 20 to 30 years, we've really seen the rise of alternative lenders in a more systematic way, and alternative providers of also different ways of originating and different processes in the back. So fintech, to give it its broader name. Alternative lending is simply that category of alternative finance that refers to any way of providing credit that happens outside of traditional banking institutions. So my company, Fulfin, we have bank cooperations, but we are not a bank, so we are subject to different rules. We have to make sure that we adhere to still to a general framework, but it means we can be quicker and we can make decisions that a bank would not be allowed to make, simply because we don't offer some of those services that banks do. For example, deposit accounts. And so let's move forward and have a little look at alternative lending and very specifically the advantages and disadvantages of this. The greatest advantage and USP of alternative lending, and this is confirmed by market surveys from amongst other Solaris banks, is simply that it is fast. It is the financial product for the 2020s, as we expect immediate gratification and we need to make quick decisions, and we're in the information age where everything is moving fast and opportunities don't hang around. It is disappointing that the financial industry is still tardy and hasn't upped its game to put a product to market where there's a strong product market fit. And that's where alternative lending has come in and said, no, this is an industry ripe for disruption and innovation. This can be done. We can make quick decisions and we can have quick processes. And that's a key advantage when you're working with an alternative lender. Generally, the approval rates will be higher as well, simply because the lenders are less constrained. So they can make decisions based on what we term in Fulfin as true risk. So we do not look at Schufa scores within Fulfin apart from a hygiene factor to check payment behavior, but we build our own scores. So we look at the data in a different way that is more relevant for our chosen niche. Because we're in a particular niche and we're very hyper-focused on that niche, we say we can understand that better and we can therefore make better decisions, and so we can make more positive decisions, and we can give larger loans based on that. And the other advantage I think that we really have is when we were referring to collateral and security previously in terms of a personal guarantee, alternative lenders are very innovative with regards to how to collateralize or secure a loan. And to collateralize or to secure a loan means to mitigate the risk in case of default. And we can do that without asking our taker of a loan, our customer, for a personal guarantee. So in Fulfin's case, the main form of alternative collateral that we use is physical products. We finance e-commerce companies, and we do product financing, and these products serve as our collateral, enabling us then to do without a personal guarantee. So
Nathan, sorry to interrupt, but I'll just give you a 4-minute warning.
Oh, well, 4 minutes, okay, right. Okay, then we have to, I thought I had 9, but if it's 4, I'll go into hyper mode. Okay, so what are the disadvantages here? Simply that these are new and novel products. So as a non-financial expert, but a startup founder, then you have a learning curve and you need to figure out what these products are. The interest rates are basically the wrong way to consider the cost of alternative lending. Alternative lending sits somewhere in between equity capital and debt capital. It enables you to take less equity capital. If you compare it with banks, it's simply more expensive. If you compare it with equity, it's a lot more advantageous to you. And when you get into this market, of course, you're going to hear new names. It's not Deutsche Bank. You're going to hear the name of Fulfin, and you might hear the name of Iwoka, and you might hear the name of Billy in factoring. So these are, sorry, Billy in factoring. So these are new and unknown names, and because financial markets and financial relationships are based on trust, then you need to get to know these partners as well. So I'm going to push through this very quickly and not spend too much time on them. I'm going to quickly talk about 3 products that we have and 3 forms of collateral. So the first product that this is the one that we provide mostly at Fulfin, is fulfillment finance or inventory financing 2.0. So effectively, we're able to give large short-term loans to companies who have physical products that they can provide as collateral for us. And we have tracking upon these collateral. We work with different partners who are basically custodians for us, and they ensure us that our loan always has physical products behind it. And what we do for a founder, then this enables a founder to buy products and to finance all of the costs associated with that purchase and the selling of those products, and to basically access a loan to do that by using those products themselves as a collateral for the loan. Another way that you could go about this would be, rather than giving your products as a form of collateral, to promise your future revenues. And with promise, I mean in terms of a watertight financial contract. And that would then serve as the collateral for the loan that you take. So this is very popular in the US. And what happens is then that you sign an agreement with an alternative lender, and you effectively state, I will be borrowing an amount X, I will be paying back an amount X plus Y%. So I'll borrow 100, I will pay back 106. But I will be paying it back out of my revenue. And every revenue stream that comes in, every month you get a payment from Amazon, or every day you get a payment from your credit card. This financial provider, this provider of credit, will take 20% of that loan. It could be 10%, it could be 30%, whatever you agree. So that's wonderful, this product, because it scales up and down with your sales success. Something that's actually an age-old product, but is having a little bit of a facelift these days in alternative lending, is factoring. And factoring is simply more for B2B startups, that when you have outstanding invoices where you have already delivered your service and that you have a claim, effectively, you can take those invoices and you can pledge them as well to a factoring partner, and they will then give you typically 80% of the value of that invoice that is due in 30, 60, 90 days. They'll give you that straight away, and they'll give you the other 20% when that invoice is finally paid, minus their fees. It's quite expensive, and it only covers a quite short part of the cash conversion cycle as well. But what's becoming exciting here is it's becoming a lot more digital, which allows you to upload individual invoices. Okay, Quentin, I'll finish up in 1 minute. So I'm quickly going to just tell you a little bit about Fulfin. I've referred to it more already, and so you can understand what we look like, what our DNA is, and what it's like to deal with us. So we offer full stack financing. So that means as a fintech focused on e-commerce, we're looking for ways that we can provide further digital services to our customers, a full digital lending experience, but also digital tools and insights to help you with your credit decisions, things that you would never ever get from the bank, where you would simply get your credit. We are now 25 people in the company. Here's a small selection of it. And you can see not many here look like your typical bank advisor sitting there with their suit on. So it is the hoodie brigade, as our customers are the hoodie brigade. We're very, very tech, and we're very, very quick, and we're the friendly face of finance in this sense. And with that, I'll say thank you. I apologize for speaking very, very quickly, but the format dictates that. And yes, we're all done.
Thanks, Nathan. I think this was a very interesting information for all of us. And I think, yeah, many of us here are asking ourselves, if you're a startup, first of all, what are the requirements that you can take such an alternative lending? And can you actually fully finance a startup this way?
So let's go in reverse. Can you fully finance a startup this way? No. Because the way to fully finance a startup right from the start, you need paid-in capital, and that is not that you will never perceive as debt financing, because it doesn't make sense from the investor's perspective. Returns to debt are much less, and at that point the company has nothing except for an idea potentially. So you need to have an equity base. That equity base can be smaller or larger, and then as you get traction, and that traction results in revenues, or that traction manifests itself in the fact that you are making product purchases, and those products you are later selling. You have something that can be used as collateral. Then you can avail yourselves to the alternative lenders, and that can be really quite quick as well. So we have e-commerce customers who are bootstrappers, and they're in the market for 3 months, and they've sold their first products, and they're ordering then perhaps their second shipment, and that's something that an alternative lender can finance.
That makes sense. I guess people can reach out to you if they have more questions, right?
We're easy to find.
For financing. Great.
Yeah.
Thank you very much, Nathan. Quentin, what's next on the agenda?
Thanks. I'm just pasting a link into the chat. If you are interested in these kinds of events and enjoy learning about startup stuff, follow us on our LinkedIn page, or you can also find us on Facebook. I'll put some more links in there. Nathan, thank you so much for your time, and thanks everybody else for showing up. Nathan is very knowledgeable, not only about finance, but also small business and startups in general. So I'm sure if you reach out to him on LinkedIn, he's happy to talk to you and answer questions, as are all of us. Our plan is to host these kinds of sessions, once a month maybe, and we'll have different people doing different things. I think Britta is organizing one with an Australian entrepreneur. And that's really interesting because Australia is coming out of their lockdowns, which is a little bit of like a view into our future here in Europe. So I'm really curious to hear what she has to say. That may be in a few weeks. I'm not sure, maybe next month, but follow us and find out. We'll post the information as soon as we've got it. Our accelerator program is recruiting now. And if you're interested in starting a company, if you have an idea, or even if you don't, it's 14 weeks. It's a highly structured program. We bring in experts like Nathan, usually 2 or 3 for each session, over 14 weeks, I said. We're recruiting, so I'll put the link in the chat. Check that out. And what else can I say? Thanks to everybody. And I hope to see you next time, and have a great day.
Thank you, everyone.
Thank you.
Thank you.
And thanks, Nathan, again. It was really useful.
It was a lot of fun. Thanks a lot. See you guys soon.